Bitcoin gave us another textbook week of structure. Early false move week beginning, a clean series of drop levels, multiple touches on the 4-hour bear flag, and Asia moving well outside its typical behaviour. So today we're breaking everything down step by step. There's also a developing macro narrative that came up in Discord this week around Japan's bond market. It's gaining a lot of attention in macro circles right now, and it actually lines up with some of the unusual behaviour we've been seeing from Asia recently. So I'll touch on that as well. Hi, my name is Janet and this is Trade Travel Chill. If you're new here, welcome. If you're returning, welcome back. Be sure to hit the like and subscribe button so you can be notified every time we upload a new video. Just a reminder that this video is for educational purposes. It is an insight to how we trade in TTC. With that being said, let's get into the weekend, because this is where the structure for the week really began. Like many recent weekends, price made an early move out of the weekend trap before the market officially opened. That early shift set us up for a potential false move week beginning, which we've been seeing a lot more of lately. Whenever a false move week begins, it usually leans more towards a day trade rather than giving us a clean swing straight away. From there, the focus becomes where are we in the model? Not just here on the 15-minute time frame, but across all the major time frames. Because the real question is, does this move have more legs in it, or is it simply the false move week beginning before we reverse into a 3-day swing? Before we break anything down on the 15-minute chart, we zoom out and get our bearings on the higher time frame. If you're new here, this is the model we trade and it plays out on all time frames. You'll start with the reversal pattern before leading into a drop level 1. We then expect a retrace or sideways consolidation before drop level 2, retrace or consolidation before drop level 3. Within each level, you'll usually find 3 hits of volume that make up the level. This can present as 3 drop levels on a lower time. So if we were looking at this as the 4-hour time frame drop level 1, then the 3 hits of volume may, not always, but may look like 3 drop levels on the 1-hour time frame. When it comes to this part here, the retrace or the sideways consolidation, this is where the levels may not play out on that lower time frame. For example, if these 3 hits of volume were 3 drop levels on the 1-hour time frame, and you find a 1-hour W, you wouldn't expect that all 3 rise levels are going to play out. Why? Because it may just be a retrace for the higher time frame. This is taught in a lot more detail within the course, but that is a rough idea. Now, if you come from a traditional trading background where you trade retail patterns, which are your flags, your triangles, and your wedges, etc., if you were to find a bear flag after a drop level 1, there is a good chance that this flag plays out. If you were to find a triangle, draws a circle, if you were to find a triangle after drop level 2, then that has a high chance of playing out as well. However, if you find a retail pattern after drop level 3, there's a good chance that this is going to fail as the market maker is setting up the reversal pattern in the opposite direction. So keep all of that in mind as we move into the price action that I'm about to show you. So if we zoom out to the 4-hour time frame and go back to the last peak formation high, which was the all-time high, we have a drop level 1 through here. Price then went into consolidation, but for those that trade pattern, it formed a triangle. Good chance that this is going to play out. It then led us into a drop level 2, and now we have a bear flag forming. When we drop down to the 1-hour time frame, this part here is my drop level 2 that I've just shown you. We have our multi-session, multi-day M formation that led us into a drop level 1, broke the 50 EMA, and the center peak of that M made a run to the 200 EMA. All typical behaviors of the model we trade. Came back to retest the 50 EMA before leading into a drop level 2, back into the weekend trap before our drop level 3. The part I am showing you at the moment on the 15-minute time frame is this move over the weekend. So back to the question, does this move here on the 15-minute time frame that happened prior to market open have more legs in it, or is it simply the false move week beginning day trade before we get the reversal into the 3-day swing? So now when I come back to the 15-minute time frame and we go back to that move that happened over the weekend, we're already cautious that it could be false move week beginning, and it is just the day trade before we hunt for the reversal for the 3-day swing. So once we've walked through the higher time frame model, the lower time frame becomes a lot clearer. We can see where the liquidity is sitting, where the traps are likely to form, and whether the weekend push is part of something bigger or just the day trade as part of false move week beginning. Monday opened strong out of the dead gap zone. Asia consolidated, UK followed, and then US made the initial move to the downside before pulling everything back into the range. Nothing major happened structurally. It was a pretty boring Monday. Because Monday was light on the charts, this is a good place to bring in the key takeaway from Jared's macro update, which explains why markets have been indecisive and why BTC keeps giving us these half moves early in the week. Jared starts by saying the market came into last week expecting the Fed to stay on autopilot. Low volatility, predictable, no surprises. Everyone was convinced the Fed would just keep supporting markets. Then Powell stepped up and tried to shut in by talking about optionality, basically hinting that December isn't guaranteed. But the market barely believed him. Rate cut expectations barely moved, which tells you traders think the Fed is bluffing. Powell also redefined what he considers neutral, suggesting rates are already in a comfortable zone. That quietly signals the Fed isn't in a hurry to ease again, even if the growth is slowing, which is more hawkish than the market expected. The problem is we're in what Jared calls a data desert. There's barely any new economic data coming out, so the markets are moving based purely on tone and Fed speeches. When you don't have data, you have vibes, and that's why everything feels directionless right now. But the real issue isn't the speeches, it's the repo market. While Powell was talking, the Fed's repo facility suddenly saw a massive spike in usage, over 50 billion in a single day. That's the largest jump since 2019, when QT broke and the Fed had to reverse course. This is a sign of funding stress building beneath the surface. On top of that, SOFR, the key funding rate, has been trading above the top of the Fed's target range. That means the market is tightening on its own, regardless of Fed policy. So even though the Fed keeps saying everything is technical, the liquidity signal says otherwise. Jared also mentioned Japan holding rates super low while the yen weakens, which adds even more pressure globally because it strengthens the US dollar and tightens liquidity further. The message he finishes with is simple. The stress isn't out in the open, it's in the plumbing, in the funding markets, the collateral chains, the shadow banking system, and those areas are already tightening, which usually shows up before any big moves happen in risk assets like BTC. So while Monday's chart looked slow and uninteresting, the macro backdrop underneath it is getting louder. Funding stress is rising, liquidity is tightening, and the market isn't confident enough to follow through on early week moves. Tuesday started with a fast move in the 30-minute gap before Asia opened, and that move ended up setting the initial high of the day. At the time, I was looking for continuation to the upside towards the liquidity that was sitting not that far above. But that idea was invalidated pretty quickly once Asia printed this lower high and shifted price in the opposite direction. What did stand out though was that Tuesday's price action gave us the fourth touch to the 4-hour bear flag. Now, we don't trade retail patterns in TTC, but we do pay attention when we see the model showing up inside the pattern. If the model is there, then we acknowledge it. From that point, Asia ran a trend and pushed outside that 1 to 2% range that we usually expect out of Asia. That told us straight away that we needed to stay open to UK or US session consolidating. And that's exactly what we got. If we zoom in on price action for the UK session, UK did Asia's job of consolidating before US came in and continued Asia's momentum, taking us down towards the lower boundary of the bear flag and giving us the fifth touch. 1, 2, 3, 4, 5. So at this stage, we now have what looks like the full sequence of the false move week beginning day trade out of the weekend, Monday's slow movement, and now early Tuesday, all folding into a single session M formation. So if we count our levels here on the 15-minute time frame, that single session gave us a drop level 1 out of Asia and a drop level 2 in the US session, which starts setting the tone for the potential 3-day swing to form. Heading into Wednesday, we were still waiting for drop level 3 to complete the 15-minute model. That was the main focus coming into the day. If you've ever wondered what a textbook Asia session looks like, this was it. Sideways consolidation within that 1 to 2% range. Clean, controlled, nothing excessive. Then UK came in and ran a trend, which is also exactly what we expect from that session. So up to this point, everything was textbook behaviour. Going into US, we were expecting one of two things. Either US would reverse the UK trend or continue it. And because we still hadn't completed drop level 3, the bias leaned towards the US reversing price. From there, UK's move created a lower high after the 5 touches to that 4-hour bear flag earlier in the week, which gave both sides of the market something to react to. If you trade retail patterns, this was the perfect trigger for you, but even for us inside the TBD system, the model was pointing clearly to the same thing. US session delivered the move down, completing the structure and giving us that drop level 3 to complete the 15-minute model. With drop level 3 for the 15-minute model now complete, Thursday was all about looking for signs that this move had more in it. With the intermediate trend and the micro trend both leaning bearish, shorts had a much higher probability of continuing to play out. Before the 4-hour bear flag started to play out, the macro trend was basically sideways and in consolidation. But when we drop down to the 4-hour time frame, which is the intermediate trend, we can see that we have lower low, lower high, lower lows. So the intermediate trend is bearish. And when we go to the 1-hour time frame, by Thursday, it was clear the micro trends had started to flip bearish as well. With the move to the downside, it was still a higher low. However, we printed a lower high by Wednesday and a new lower low by US session on Wednesday. So now the micro trend definitely aligns with that 4-hour trend of being bearish. So now if we stay here on the 1-hour time frame and go back to the most recent peak formation high and start to count our level, Tuesday gave us the V-top, and throughout Tuesday and Wednesday's price action, that gave us a drop level 1. So heading into Thursday, we should be anticipating a reset lower high in preparation for drop levels 2 and 3. From here, there are 3 things we always do. Mark out key areas and identify the zones with the highest confluence. This could be finding a vector candle that aligns with an EMA or a Fibonacci level. So if I draw a fib from the peak formation high to the bottom of how I have counted the level, drop level 1, I can see that the 38.2 fib lines up with the 50 EMA roughly, and the 50 fib lines up with the 200 EMA. If I mark out this high volume vector candle, we can see that 50% of this high volume vector lines up with the 50 EMA, the 38.2 fib, and a full recovery of the vector lines up with the 200 EMA and the 50 fib. So it is clear that the area between the 38.2 and the 50 fib is going to be our area to watch for weakness. So now it's just a matter of dropping down to the lower time frame to hunt the entry for the better risk to reward. So now when we drop down to the 15-minute time frame and zoom right in on Thursday's price action, we can see right at the end of the Asia session, Asia extended to the upside. This is typical behaviour that we like to see. Heading into the UK session, we got a lower high. This here signals a multi-session M formation in the area of interest where we were looking for that weakness to happen, triggering a short entry. From there, UK shifted fast for a moment before slipping into consolidation. Luckily for anyone in our community, we host a live session before the opening of each new session. So even if you missed the multi-session M, there was another clean entry right at the start of the US session. Overall, Thursday was a good day for our community. We had Cody taking the Asia session And in his update, he predicted the move perfectly, expecting Asia and UK to come back up into this area of interest before printing the lower high in the US session to come down. So you had a whole 2 sessions to get an entry on that one. And during the Thursday US session, I mentioned that I was overall bearish, showing what I was looking for heading into the US session open. So basically a lower high into this red vector candle before continuation to the downside. So you can see that in the US session we did get that lower high that came back to recover this vector candle here to give another entry before we see that momentum continue to the downside. On top of that, we had another key macro update from Jared that is worth mentioning. This update explains that almost every major market showed signs of stress this week. Stocks pulled back, Bitcoin sold off, repo markets tightened, and SOFR jumped above the Fed ceiling again. All of these point to the same thing. Liquidity is thinning beneath the surface. He starts by noting that Bitcoin's drop isn't isolated. When liquidity tightens, the most speculative assets get hit first. And this week's move was a clear sign that risk appetite is shrinking across the board. Next, the common narrative gets addressed. People keep blaming QT and a shortage of reserves for the stress, but the system actually has more than enough reserve. The real issue is collateral scarcity and a decline in risk-taking within wholesale funding markets. Ending QT won't magically fix SOFR or repo stress. There's also a reason QE talk suddenly exploded this week. Not because the plumbing requires QE, but because markets want the psychological boost that QE provides. It's sentiment driven, not mechanical. December 1st becomes an important date. QT ends for treasuries, which keeps the balance sheet flat, but doesn't provide real easing. It's neutral but not stimulus. The most concerning detail is that the Fed has been quietly calling banks, asking why no one is using the standing repo facility. When central banks check whether emergency tools are working, it usually means they're seeing stress that the public can't yet. His blog closes by pointing out the contradiction. On the surface, liquidity looks abundant, but repo rates, SOFR, risk assets, and even energy markets are all signaling the opposite. Bottom line, liquidity appears fine right now until the moment it isn't, and we're moving closer to that point. Friday opened in the dead gap zone with a retest of the 50 EMA, which gave us an early clue that the initial high of the day might be in for the day. Then Asia opened with another lower high, again off the 50 EMA, adding even more confidence to that idea of a clean scalp entry for anyone trading the Asia session. From there, Asia ran a trend moving outside that typical 1 to 2% range, leading into drop level 2 with the UK session finishing off that drop level 2. US session then came in and finished off the model perfectly for the 15-minute time frame, completing drop level 3 and sending us straight into another weekend trap. The Humble Brags channel has been absolutely pumping this week. So many solid setups and clean model plays coming through. We had NJ put out a short setup on Link, and so many of our members caught that entry beautifully. You can see price came back up into the area he had marked out and price pulled away nicely. We also had Deanfrank take that short on Link, making enough to pay for 6 months worth of membership at TTC. And we have Cajun Spice, who has been on fire this week with his live session setup and session updates, with a lot of members catching profits from his sessions as well. We have Sassy Kiwi with her opinion on this week being the easiest weeks in regards to the method playing out, banking profits on Solana and BTC. We have Hazel with a scalp on a Sunday on HBAR, banking 174% and 19% on ADA. And Lucy in the Sky with a short on Zcash, banking 32%. So all across the board, our members have been banking profits on the shorts all week. So if we zoom out and look at the model from the 4-hour time frame down, we're sitting in drop level 3 on the 4-hour time frame, and on the 1-hour time frame we have 2 drop levels before heading into the weekend trap. So the expectation would be that we start the week bearish to at least give us another drop and complete the model here on the 1-hour time frame. That's the context we're carrying forward into next week, and whether BTC follows through depends on how it opens and how it reacts to the key events coming up, like Nvidia earnings on Wednesday and OPEX on Friday. And while we're on that, there's something interesting that was shared in Discord this week that again is worth mentioning. I think anything that comes from Jared is worth mentioning. Dario highlighted a developing narrative around Japan's bond market that's starting to make a lot of noise in the macro circles, and Jared shared it with the community. Not because he agrees with it, but because it's gaining traction. The idea is that Japan's 10-year yield pushing up into the 1.7% zone may be signalling a shift in how Japanese capital flows globally. When JGB yields rise, it puts pressure on Japan to print more yen to cover higher interest costs, and historically that's been linked to a weaker JPY and changes in how Japanese investors allocate capital offshore. You don't need to buy into the narrative completely. Even Jared said he doesn't agree with it 100%, but it's a useful perspective to keep in mind, especially given what we've seen from Asia recently. Asia sessions have been selling off harder than usual, moving outside their typical 1 to 2% behaviour. And when you pair that with rising JGB yields and shifts in Japanese capital flows, it does add another layer to why certain sessions have felt heavier. So going into next week, we're looking at two things at the same time. The BTC structure, which still has room to complete on the lower time frame, and the broader environment where liquidity narratives, especially around Asia and Japan, may continue influencing how sessions behave. And if you want to stay ahead of all of this, make sure you're inside TTC next month. We're taking December off YouTube, but we'll still be trading as normal within the private community, running our live sessions, posting updates, and breaking everything down together. To join us, use the link in the description below.